Okay, good evening, everyone. Welcome back to our live sharing class today. Happy weekend. Here, we're going to continue to share some knowledge about stock investments and financial concepts, hoping to inspire and help you along the way. So, first of all, I would like to thank you all once again. With your strong support, we successfully completed the first phase of the competition for the location of the Asia Pacific headquarters this Friday. We've secured a victory in the first phase with a significant lead. So that's going to lay a solid foundation for our future competition for the Asia Pacific headquarters location here in India. Now, this achievement is inseparable from your support. Of course, as you may already know, in the past 2 days, I have also conducted further negotiations with other relevant institutions for our upcoming wealth growth plan. I will touch more on this a little bit later during this class. Next, let me briefly introduce you the contents that we're going to be sharing this evening. Hopefully, that you will all gain more insights during tonight's live sharing session. So, what specific content do we want to share with everyone tonight? Regarding the wealth growth plan, we are about to enter a new phase. We talked about it last Friday, but maybe some people here still don't understand it very well. So, I will give you some related instructions on what to do next. At least let everyone know what we're going to do step by step. These are all going to be implemented step by step, and we need to take solid steps to execute them. Furthermore, I will also introduce some concepts related to investment and finance to help everyone better understand the operation and laws of the markets. We will also share some practical investment skills and strategies to help everyone achieve better results in their investments. Now, I want to thank everyone for their participation and continuous support. In the upcoming classes, if there are any questions or doubts, you can raise them at any time after the live broadcast, and I will do my best to answer them. I hope today's sharing can bring new gains and inspiration to everyone here as well. So, let's begin going over the contents one by one. Market recap. We always like to kickstart off our day with the market recap. So let's review the domestic market in India this week. Overall, the market saw a considerable decline this week, which also can lead to a certain impact on the bullish sentiment in the market. Now, specifically, the Sensex and the Nifty 50 fell by 1.64% and 1.87% respectively, while the BSE mid-cap and small-cap stocks dropped by around 3.5 to 3.9% respectively. So out of the 50 stocks in the Nifty 50, only 13 of them showed positive returns, indicating a very, very poor profit effect. Looking at reasons, generally speaking, the massive selling by foreign institutional investors, widespread uncertainty surrounding the elections, and the weak signals of profitability in the fourth quarter of large cap companies have all suppressed investor sentiment in the domestic market right now. The performance of the stock market this week may not be even satisfactory with a poor market environment. Now, during times of high market volatility, we should not blindly, optimistically, or swayed by emotions, but rather we've got to remain calm and rationalize. It is important to adjust investment strategies in a timely manner and reduce the investment risk of common stocks as a top priority. Now, at the same time, we should maintain patience and confidence. Market fluctuations are always temporary, and in the long term, the fundamentals of investments determine long-term growth of returns. Although the market is challenging, our wealth growth plan still has the ability and strength to earn sufficient profits. Since the beginning of this week, regardless of how much profits has been made, it is safe to say that everyone has indeed made a profit. These profits can be withdrawn, and I believe that in future investment journeys, we will encounter better opportunities and better returns. Next, we're going to directly take a look at the two major stock indices in the Indian stock market. So let's take a weekly chart of the Nifty 50 index. Now, previously, we have been talking about how the Nifty index has a clear uptrend channel on the daily chart. And the current prices has just tested the lower boundary of the uptrend channel, which is the uptrend trend line below. Although there is some support here, it may not be strong enough to hold. In fact, for those people who have been participating in my live broadcast or group content sharing recently, you should have a rough idea of my views on these two big indices. My view tends to lean towards the notion that the support from the lower uptrend channel line may not be strong enough. Now, why do I think so? So let's directly examine the weekly chart. If you look closely at this chart, you can all observe a phenomenon. In this uptrend channel, there have been several instances of significant drops in the candlestick patterns. Why were there rebounds after the previous drops? But this time, I am inclined to believe the support may not be sufficient. So from previous charts, it can be seen that the significant drops in the candlestick patterns often occur near the top of the channel. Even if there is a significant drop in the candlestick patterns, there is momentum in the decline. There is still room left by the market. However, this time the significant drop in the weekly candlestick pattern is closer to the bottom of the channel, which means that there is some momentum in this drop and it may directly break through the support line below. The current uptrend channel has been maintained for a relatively long period of time. We all know that regardless of the form, nothing can be maintained forever. When such an uptrend channel reaches a certain point in time, it will either choose to break upwards or downwards. In the current market situation, do you think the probability of breaking upwards is higher, or is the probability of breaking downwards higher? I'll leave the specific answer to this question for you to think about. I believe everyone has a clear answer in their minds. Okay, so we're going to be taking a look at the Sensex index now. This index is slightly different from the Nifty 50 index. The difference lies in the fact that the rise of the Sensex index embeds a small upward channel in a larger upward channel. Now, this is not the case for the Nifty 50 index at all. However, this does not affect the overall upward trend of the indices. Currently, the Sensex index is facing the issue of breaking below the upward trend line. Just now, some of you may not have seen clearly with the Nifty 50 index and may think that once the index breaks below, it turned into a complete bearish trend. That is not the case here. I want to introduce a concept to you all, which is that no matter what kind of trend, it should be viewed within a time frame. Discussing trends without considering the time frame is pretty much meaningless. Now, after hearing this, some of you may be a bit confused about what I want to convey. I want to tell you, even though the index may break below the current upward channel, the higher level bullish trend will still remain strong. Now, to ensure that everyone understands what I'm trying to talk about here, I summarized it in two major points. So the first point, even if the market falls below the current upward trend line, the higher level bullish trend will still remain strong. This is a matter of time cycles. Number two, once the index falls below the current upward channel and continues downwards, although the larger bullish trend remains intact, the short-term adjustments will still impact the prices of many stocks. Therefore, I've been emphasizing the importance of controlling high risk levels to all of you for quite some time. So have you all understood analysis of the market trends I just explained? Okay, so maybe take some time to digest the market trends and what I've been trying to go over in the last week, even for a week. The volatility is high, so this is what we got to deal with, the adjustment in the short term. So let's dive into the news. So we just conducted the review of the Indian stock market. I've shared my own views, my own opinion, hoping that my perspectives can bring you some knowledge and reference. So next, we need to focus on fundamental data and news. Why do we always insist on sharing fundamental related content with everyone? Because fundamental information can lead us to many different conclusions. At the same time, fundamental news provides important clues about the economic and industry situation. Now, these news can include national economic data, company financial reports, industry trends, etc. There's so many things that it's going to cover, which are vital for investors to understand the macro and the micro environment of the market. Analyzing fundamental news can help investors grasp the overall market trends and tendencies, thus allowing for better formulation and investment strategies as well as decisions. All right, we're not going to dwell too long on this. Let's continue to look at specific related relevant content and see what different results we can interpret today. So the first piece of news, the CEO of Punjab National Bank in India stated that they are seeking to complete the sale of institutional stocks within 6 months. The news itself is not important. What's important is to let everyone know that this financial market, or more accurately, in the stock market, there are many things that you didn't know before. Just because you don't know doesn't make them non-existent. So what is this news is about is the Punjab National Bank, the PNBK, announced on Friday that the state-run bank aims to sell stocks to large investors in the next 6 months to bolster its capital. The banking sector of the third largest economy in Asia is reinforcing its capital base to meet the growing lending demands. The country's largest bank, State Bank of India, is also in the process of raising capital. The board of Punjab National Bank approved raising 75 billion rupees, which is roughly about 898 million USD, through equity capital in December. Now, qualified institutional placement, we're going to call them QIP, involves selling stocks to institutional buyers without issuing them publicly. Although, here's something to note. As I mentioned earlier, these stocks are being sold to institutional buyers, not the public. This means that regardless of how the final 75 billion rupees worth of stocks are traded, for ordinary investors in the market, it is not visible in the secondary market, and they do not know how the transactions are happening. So when you can't see these transactions at all, would you still believe that they do not exist? There have been some people who have been puzzled. We distribute stocks to everyone through the process of taking on shares. Where do these stocks come from? It's through these methods described here. Of course, this is just one of the ways among many. You need to know that such a method actually exists. Completing a transaction isn't as simple as it might seem from my explanation. It involves a lot of work, cooperation, and negotiations. It's just that you're unaware of all of these. Looking at it from a different perspective, do I need to disclose all my work content, my work details, and even confidential matters to you? Obviously not. Every industry has its rules. Okay, so understanding the general of this idea should be sufficient. I don't want to dwell on it too much, but there are a lot of things that happen behind closed doors. So we're not going to get into the details of those. Next up, I'm going to bring everyone some not so wonderful news. Of course, even if it's bad news, it's something It's not something that I created, It's something that's happening around all of us. So what we need to do objectively is assess the current market situation and adjust our corresponding response strategies. So this next one is about Fed officials mull whether rates high enough as inflation expectations are jumping. So this week, the debate among Federal Reserve officials over whether U.S. interest rates are high enough deepened. And a key survey showing rising consumer inflation expectation could further intensify this debate. So Dallas Fed President Lori said, I think there are significant upside risks to inflation. And I believe there is uncertainty about the degree of policy restrictiveness and whether the restrictiveness is enough to bring inflation back to the Fed's 2% target. So Logan stated, I think it's premature to consider a rate cut now. I believe I need to see some uncertainties on the path we are following resolved. And we need to remain very flexible. She did not directly address whether she believes the Fed may need to raise the benchmark policy rate from the range of 5.25% to 5.50%, which was maintained since July. Now, many Federal Reserve officials, including Fed Chairman Powell, have stated that they believe further rate hikes are unnecessary. As can be seen, although market expectation calls for a Fed rate cut in September are gradually increasing, there are also dissenting voices. Everyone knows that a rate cut is beneficial for global stock markets. With the current increased uncertainty in Fed policy, it means that most anticipated benefits in the market may still need time to materialize. Therefore, for the Indian market, adding various uncertainties such as FII selling, uncertainty surrounding elections, and so forth will exert greater pressure on the Indian stock market. It is unlikely that the Indian market will perform well in the short term or see a significant rebound. In the coming period, ordinary stock trading should remain cautious and risk aware. And we've been going over that for a while now. No matter what we're going to do in the stock market, we have to proceed with caution. It is a volatile time. It's going to be like that for a little bit longer in the short term. So we have to be patient. We must find other ways to make money. Now, recently, the market's weakness can be clearly seen in front of investors. Although the market ups and downs have always had various reasons, the ultimate driving force behind the market movements is the flow of funds. So let's take a look at the recent capital dynamics in the market this month. So recently, and even from previous month, our FIIs have sparked a selling frenzy in the Indian market. Up until now, the total outflows of funds in May 2024 has approached nearly 250 billion rupees. As of the first 7 trading days in May 2024, the foreign institutional investors have sold around 249.755 billion rupees, with sales occurring every day. Domestic institutional investors, or DIIs, according to stock exchange data, have been net buyers on all trading days with a total investment of 194.1 billion rupees. Now, this is a good sign. We have a lot of domestic money that's staying in India that is pumping up our stock market, despite the fact that the FIIs are leaving. Now, from this data, it is clear to see that although DIIs have been continuously buying, they have ultimately been unable to match the strong selling pressures from the FIIs. In fact, the significant selling by FII not only directly brings financial pressure to the market, but more crucially, it affects the market's psychological factors. What is the reason behind such large-scale selling by the FIIs, you might ask? So first, the high yields of U.S. Treasury bonds. The first triggering factor for foreign investors and foreign portfolio investors, massive selling of stocks and bonds is sustained rise in US bond yields. Capital is always profit driven. And currently, the 10-year Treasury bond yield is hovering around 4.7%, which is hugely attractive for foreign investors. Secondly, investors seem to be cautious about entering the market before the election results. With many booking profits to secure their gains, this concern has led the country's volatility index, India's VIX, continuously climbing to a high of 19.7. Excavating market worries. So, election is around the corner. A lot of uncertainties on which party wins. So, that's another driving factor. Third, the hawkish stance on the Federal Reserve. Now, the Federal Reserve has maintained the key overnight rate at the highest level in 23 years since July 2023 at 5.25 to 5.50%, and has indicated that it will maintain high rates until inflation cools down and continues to rise within the target range. Furthermore, the unexpectedly low voter turnout for the elections has caused concern. Our view is that uncertainty has arisen about whether the ruling regime can secure a smooth victory. Analysts have expressed that the market had discounted the victory of ruling by the Bharatiya Janata Party. But now there are some uncertainties. As aforementioned, reasons are not only factors behind the outflow of FII funds, but also important factors contributing to the recent weakness in our market. For us traders, we don't have the power to change the market. Nobody has that kind of power. We can only adapt to the market and make corresponding strategic adjustments. And that's the stock market in a nutshell. We have to look at all the facts that we have, and we must make adjustments according to what's going to be working. Okay, weekly profit time. Now, this week, the market environment may not have been satisfactory as well as we hoped for, but I am delighted to announce that we have achieved a very, very good performance. Despite the unpredictable market fluctuations, our team has maintained a stable investment strategy and achieved fairly good results. From this statistical table, everyone can see that this week we have gained approximately around 30% of net profit altogether. Of course, this is just a rough estimate. Some of the members have a slightly different result, but I don't think that's too important because what matters the most to me is everyone's overall profit situation. Although this profit is not considered significant, my friends should not feel content because of it. I believe it is far from enough to fully reflect the profitability of our wealth growth plan. And that's why I've been in further discussions with relevant parties over the weekend to maximize on everyone's returns. So, dear members, despite the challenges and uncertainties in the market, our profit model is far from ordinary exchanges. The sophistication and the profitability of this model, we have all felt and experienced this by you for now. So I'm not going to elaborate any further. So currently, the profits we have achieved do not signify great success. It is only the beginning of our wealth growth plan and just in the exploratory phase. In the upcoming investment journey, we will continue to uphold a prudent and practical attitude to provide everyone with higher quality investment services, helping everyone achieve their wealth growth goals. At the same time, I would like to express gratitude for everyone's support and trust. Let us together face future challenges and strive to create a brighter tomorrow. Okay, so as of Friday, I mentioned to everyone the activity of competing for the Asia Pacific Regional Headquarters has completed its first phase. With everyone's strong support, we have achieved victory only in the first phase. Of course, this is only one phase victory. So the upcoming second phase is going to be more crucial. The focus on the next phase competition will be the asset management scale of each region. So this will test the user funds and operational capabilities of each region and their respective teams, as well as profitability and other things along with it as well. So since we have entered the phase of competing in asset management scale, starting next week, our main focus will be on accumulating funds to prepare for major actions moving ahead. Therefore, I mentioned earlier, the profit results achieved this week may look good in this market environment, but I still believe it is far from enough. During this weekend, I have also conducted further negotiations with other collaborating institutions. I can now inform you that the negotiation results are quite good. We have obtained some higher quality and more discounted shares, which means our profit potential will be greater in the future. Also, over the weekend, we have signed related cooperation agreements with some new collaborating institutions to ensure the smooth implementation of our next phase of wealth growth plan. As for specific information on tomorrow's block trading deals, discount rates, and more, I will inform everyone in the group later, so please stay calm and be patient. Additionally, it is important to mention that starting from tomorrow, after selling the stocks, the company will gradually reclaim the trial capital. The profits earned by everyone can be withdrawn, so please pay attention that only the profit portion can be withdrawn. For specific details on how to withdraw profits and how to authenticate your identity, everyone please consult my assistant. Remember, you must conduct the identity verification and profit withdrawal according to the guidance from my assistant. So that's a little bit of good news. Okay, jumping into Zurich law of speculation. Now, we will proceed with the sharing of this. Today, we're going to continue to learn about some more aspects and more laws. I want to emphasize here that no matter what law or who has advanced experience, when we are learning, we need to treat them open-mindedly. Not all experiences of all people are suitable for us or suitable for the current market situation. We also should not set a strategy that suits us all the time. There's no one shoe that fits all. So after learning, everyone also needs to apply it flexibly. Regarding the Zurich laws, this is a term used by a group of Swiss people who were engaged in stock speculation in the early days of Wall Street stock market and hope to become rich as a result. It includes a practical and relevant set of laws that can provide any investor or speculator. Investment and speculations are essentially the same. So in the future, will just be used interchangeably. So with rules of engaging in the money game and controlling risks. Now, I've always emphasized controlling risk is very, very important in the stock market. So last time I shared some content with everyone in regards to the laws. So now we're going to continue going over two more laws. So let's look at Zurich's law number 3. When things starts to sink, don't pray. Get out of here quickly. So this thing has been passed down for a long time, and it deeply reflects the reality and the important principle in the investment world. When the stock market trend deteriorates, one should immediately exit, even stop loss and admit defeat on this one specific stock immediately, and not let yourself be trapped. In this regard, investors need to overcome not only the psychological barrier of fearing the immediate rebound after selling stocks, but also two other psychological barriers: unwillingness to bear small losses and always hoping for a market to rebound without admitting their own misjudgments. In fact, making mistakes in buying or selling is gonna be common, not a cause for excessive surprise, but it is important to avoid making mistakes to an extreme degree. When we minimize our mistakes to as low as we can, we continue to have room to grow, right? Now, we all know that market fluctuations are inevitable, and sometimes there may be significant drops. In such times, many investors may feel panic and even hope that the market will rebound through prayers. However, for wise investors, prayer does not solve the problem, but decisive action is needed instead. It is crucial to exit in a timely manner when the market begins to decline. This means having the courage and the determination to limit possible losses. Holding on to losing positions will only make the losses grow, potentially causing serious financial impact. Of course, exiting in a timely manner does not mean blindly following the crowd to sell. Investors need to make the judgment based on their investment plans and risk tolerance, combined with the actual market conditions. Now, sometimes a market decline may only be temporary adjustment rather than a change in the long-term trend. An excessive panic at this time may result in unnecessary losses. Just like the recent situation, if everyone holds only a small amount of quality stocks, then even if the market is in the adjustment phase, it is not a fatal problem. However, one thing to note is that we must not superficially understand what I am saying. If you hold a heavy position of common stocks and the situation with the stocks is not looking good, then it requires a different approach. Just like Law 3, don't pray, get out quickly. In conclusion, when the market starts to decline, do not pray, do not hope, but decisively exit. This is not only responsible for your financial security, but also respect for investment principles and its concepts. Only by maintaining calm, rationality, and taking timely action can you maintain a stable investment performance in the market fluctuations. So that is very key. If you are unsure, you can just sell it really quickly, whether it rebounds or whether it keeps on going down. Overall, your quick, decisive decision is going to be saving you in the long run. Okay, so let's continue to look at the fourth law of speculation in the Zurich laws. As long as there is a reasonable explanation or intuition, it can serve the basis for speculative activities. Now, when intuition or premonition arises, why not reflect on where it comes from? If you have shown a considerable degree of concern or research on certain speculative tools in ordinary times, or even have a certain degree of mastery over them, you might as well trust your intuition. Of course, it may not be 100% correct, but it is important to note that hope should not be confused with intuition. Usually, when intuition tells you that the development of the situation will be opposite to what you hope for, this kind of intuition is often reliable. This is a widely held view in the investment community. Of course, there is some controversy behind it. Speculative activities are often influenced by personal intuition and premonition of investors. However, we also know that relying solely on intuition and premonition for speculative activities is far from enough. Market fluctuations are often influenced by multiple factors, and sometimes even experienced investors find it difficult to accurately predict market trends. Relying on intuition for speculative activities may lead to blind follow-up or overconfidence, ultimately leading to losses. Although intuition and premonition should not be ignored, they should not be the sole basis for investment decisions either. Investment decisions should be based on thorough research and analysis. Only on this basis can one better grasp market opportunity and risks. In summary, although intuition and premonition play a certain role in speculative activities, they should not be the sole basis for investment decisions. Investors should maintain caution and rationality, consider various factors fully, and make corresponding decisions based on actual situation in order to reduce investment risks and achieve long-term stable investment returns. This is also why I say for any for any experience, technology, etc. One should engage in learning. Everyone needs to digest this well. So friends, do you all understand? Okay, so before we jump into oscillations and breakthrough with everyone, last time we didn't finish it. So today we're going to arrange to further explain and share content related to this aspect. So why do we continue to share this content with everyone today? Mainly because of 3 reasons. Number 1, in fact, many people have studied this content before, but there are still many knowledge points that are not very clear. And they have always asked me if I could talk more about the skills and methods in this regard. Of course, I personally believe that especially the concept of breakthroughs, if we master this well, it will greatly improve our profitability. Of course, I personally also like to operate on the market opportunities after the breakthrough. Number 2, experienced traders all know that fluctuations in the market is an avoidable topic or market trend in our trading careers, because any trading instrument, whether it's a stock, spends most of its time in fluctuating market trends throughout the year. From a time perspective, even if a stock is a big gainer, spending time in a smooth uptrend, it is not a lot of time, and most of the time it's in the fluctuating market. So therefore, how to deal with fluctuating markets is one of the standards to test a trader's technical capabilities. Number 3, we all know that trading is difficult in a fluctuating market, but it is not impossible. It is possible to make money in a fluctuating market. It just requires more effort. In fact, the larger profit often lies hidden behind these breakthroughs in a fluctuating market. So this is going to require, first, to be able to identify these fluctuating markets and be able to profit from it. Second, and more importantly, we got to seize the large profits after the fluctuations. Okay, so rectangular oscillation. Now, this is a very, very common and also a very important form. So why do I say that, right? On one side, this form is very easy to recognize. And then on the other side, the profit space for this rectangle breakout is enormous. So just a little bit of a recap. What is a rectangle oscillation? So as shown in the figures, within the range of a parallel upper pressure line and lower support line, the repeated rise and fall state is called a rectangle. Looking at this figure, it's quite clear. In fact, facing this figure, everyone can roughly identify where the trading opportunities are. After the price breaks out of this rectangle, it is highly likely to continue the trend before entering into this pattern. This means that if the trend before the rectangle oscillation was upward, the rectangle is highly likely to break upwards. If the trend before the rectangle oscillation was in a downward trend, the rectangle is highly likely to break downwards. Hence, this type of form is called the continuation pattern. So there are 2 types of rectangle oscillations. We have the bullish rectangle oscillation and we have the bearish rectangle oscillation. As for what constitutes bullish and bearish, it mainly depends on the direction of the trend before the form. Of course, since we're talking about stock trading here, I will only share with everyone the bullish rectangle oscillation. So as you can see on my graph, you notice on the left side, we got the trend is going upwards. You see this green line, then it bounces around and it continues to go green. So that means it was going up before, then we hit this market fluctuation, it continues to go up. And then on the right side, we have it vice versa. We got the red one going down, rectangle, and then it continues to go down afterwards, right? Okay, so just now we mentioned that any oscillation pattern presents 2 trading opportunities. One is buying low and then selling high within the oscillation range, and the other is following the trend after the pattern breakthrough. The rectangular oscillation pattern is the easiest to identify among the oscillation patterns. As long as its oscillation range is large enough, the profit opportunities provided before the pattern in terms of buying low and selling high are very rich and easy to capture. So I want to talk about the two profit opportunities of this pattern in particular with you all again. So let's directly take a look at this graphic example that I have shown here, which will make it more intuitive. When we can see that a various obvious rectangular oscillation appears here. Now the price first rises, then it begins to oscillate. When we draw the resistance and support lines, we can see that a clear rectangle has formed. After the box of oscillation, the price generally continues in the original trend. The trading opportunities can be divided into two types. So number one, everyone, pay attention to the buying and selling opportunities I've marked within the rectangle. Here I also have a question for everyone. Why do you think I marked the buying and selling opportunities in these two places? You must think about it. The opportunity of the rectangle breakthrough I have also clearly marked. I'll use an example to share this with everyone, the main purpose of which is to help everyone remember this type of pattern and such trading opportunities. You don't need to worry what specific stock it is, right? So as you can see here, these are your buying points. We got a rectangle oscillation and bang, it continues to go up. Now, previously, before we hit this rectangle box, you can see another blue arrow. It was slowly on an upward trend. Okay. So we just went over the rectangle oscillation. Let's continue with our next oscillation pattern, our flag oscillation, which is also a classic and very, very common price pattern. So what is a flag-shaped oscillation? The flag pattern is a price pattern indicating the continuation of a main trend. Typically, the flag pattern will appear after a strong upward trend represented by a flagpole shaped upward price line. Then it corrects within the price channel and then it breaks through the edge of the flag shape and moves in the direction of the previous trend. The same is true in its reverse. So the bullish and bearish, same thing. Strong upward trend, then it does a slow correction, and then bang, it skyrockets again. Now the flag pattern indicates that the market is resting after a strong trend. It should tend to lean opposite to the previous trend, preparing for the continuation of the rebounding main trend. The flag pattern is usually much shorter than the previous trend. So currently, the flags everyone is seeing, including the rising flag and the falling flags, so the bearish and the bullish. Similarly, we will only talk about the bullish flag, not the bearish flag. Okay, so with the two types of flag patterns, the bullish flag and the bearish flag, of course, just like before, we're only going to share the bullish one with everyone here. Now, the bullish flag pattern, also known as the bull flag, is a pattern where the flagpole exhibits a strong and steep upward trend. So take a look at this chart. In the flag area, the price will correct within a descending trend channel with two parallel support lines and resistant lines. When the price breaks through the resistant line, buying power will strengthen again and begin to soar. This is a good buying opportunity. However, it's important to note that generally, after the flag breaks upward, the strength or the magnitude of the subsequent rise is usually smaller than that of the rectangle breakthrough. So, on this picture that I've shown here with the bullish flag, the pole is the original uptrend. So it makes a little flag pole, and then we draw the two lines to make it the flag, and then it goes up again. But you have to remember, whatever the trend is, your support and resistance line must go the opposite way. So if we're on an uptrend, the correction must be on a downtrend. Vice versa. If it was the other way around, it's on a downtrend, your flag has to start to slowly go on an uptrend, right? Okay, so what else do we need to pay attention to when using the flag pattern in practical applications, right? So these are some of the precautions that we must look out for. So number one, the flag pattern indicates the continuation of the main trend. The previous pattern should be a strong upward and downward trend. Now, I'm going to emphasize strong because it has to be a strong to make the pull, right? If the previous trend is not strong, the accuracy of using this method for judgment will also decrease slightly. Number two, the sign of a good signal pattern must have a slope in the area of the two parallel lines that we draw. Importantly, the slope is opposite of what the flagpole is. So as I said, if the flagpole is going up, your correction must be going down. If the flagpole is going down, the correction must be going up. Number three, the period in which the pattern is formed is also known as one of the more important factors determining the accuracy. Number four, volume usually tends to weaken during the formation of the pattern and increases when the prices break through the support or its resistance. So always have the volume indicator out as well, right? Now, combining several other technical indicators will improve the accuracy of the model. So have other indicators. Cross-check with whatever you must cross-check it with, right? The more indicators that confirm one pattern, the more accurate it's going to be. So that is what I wanted to add on to our oscillations and breakthrough. I wanted to show people the more common patterns. So we got the rectangle as well as we got the flag. So pull out some of the stocks that you have in your portfolio. Take a look at those trends. You will start to see resemblance. And then that's how you're going to get better applying it to your everyday trading. Okay, so usually the last part of our evening, we got our stock analysis. So we're going to start tracking and analyzing some of the stocks that we recommended to everyone before. Now, I'm going to say this again. As long as it's a stock that we recommended, we're going to track it all the way to the end. And we're going to take responsibility for this, right? So you should all know that recently, mainly due to the overall downward adjustment of the market, the vast majority of stocks in the market have experienced a certain degree of decline. And the stocks that we recommended are no exception to them at all. So I've also told everyone that as long as you have losses from following these stocks that I've recommended, we're going to take responsibility all the way. So regardless of current ups and downs of these stocks, no matter how they eventually hit the upper limits or whatever it may be, we will definitely help you earn it back in our wealth growth plan. So why do I say this? Because only when we track and analyze stocks without psychological burden, it is relatively more objective and not controlled by emotions. So as not to make some wrong decisions, okay? So I'm going to go over some of the stocks that we've recommended. All right, so let's first take a look at the stock NCC, right? We can notice that on Friday, this stock hit a new low again. At the same time, the stock price also dipped in the recent uptrend line. Now, we don't care temporarily about the reasons behind this, whether it's because of a significant recent decline or hitting a support. Ultimately, there was a strong rebound during the day, and the candlestick of the bottom probing and rebound appeared. Now, regardless of the stock price falls to the current level, there's been active buying interest at low levels. I still need to observe this for about 2 trading days. So if the price of the stock does not fall further, we will confirm the trend of the rebound. Now, we mentioned earlier that this stock is relatively resistant to declines, meaning it resists to keep falling. The main reason is that the stock is originally a good stock. It's a long-term bullish stock. So what does it mean in long term? In the short term, it might have some negative fluctuations. The bullish trend of the stock is still good at the moment, so there's no need to be overly anxious. For people who have bought this stock, they can continue to hold. If we need to sell this later on and cut our losses, we're going to notify everyone. Okay, so moving on from the stock, we are going to be looking at Capacite. So this stock also experienced a certain degree of bottoming out and a rebound on Friday, but the overall strength of price recovery is much weaker than the previous stock. Now, the stock was also wrongfully undervalued due to the recent overall market adjustment. From a technical perspective, the stock price has returned to below the high point in January of this year. So re-entering the previous trading range. To be honest, although the candlestick chart on Friday also shows some buying pressure below, these buying forces are currently insufficient. As for when a strong rebound or reversal will occur, it requires further signals from the market. So my personal opinion tends to be that as long as there is a certain opportunity or the atmosphere of a rebound in the market, this stock will experience a strong uptrend or rebound. Now, as mentioned earlier, the current overall market decline is caused by multiple factors. We got elections, we got FIIs leaving, we got tons of factors. So engaging in trading ordinary stocks in the near term is going to often lead to more losses than to gains. But everyone, we cannot reverse the overall market downturn, nor can we change the market trend. But for those who incur losses from buying the stocks we recommend, they can contact the assistant and register the losses, and I will make arrangements to ensure everyone's losses are recovered. So you're going to have a general idea now about what the stock market is going to look like with our two indices. So if the indices are doing bad, most of the individual stocks are going to be doing bad. Okay, so that is going to wrap up for today's online course. We went over a lot of content. We got 2 new Zurich laws. We dived in a little bit more in oscillations and breakthrough. So please go over these content, memorize it, and apply it to your real life trading strategies. Our next online class is scheduled for Tuesday, May 14th at 8 p.m. I hope to see everyone here again. Thank you very much, my friends, for your strong support, and I'll see you all next time.